Hi, everybody. Welcome to today's Powerplay Tuesday. I apologize for the delay. The wonders of doing a live recordings. Sometimes the internet just betrays you at the very last minute. So thank you for working with us. We really appreciate it. Thank you for joining us. Today's topic is something that actually I'm really excited to cover because it's not necessarily going to be talking about the mechanics of investments, which is what a lot of people are talking about. Today, Paul's going to be focusing more on the philosophy, and I'll speak on that in a sec here. But before we get started, got to give you the run through. Everything you're about to see here is for your educational purposes only. So it's important to understand the role that Quest will play when it comes to your retirement investments. We're here to facilitate as many whatever transactions you like and provide as much resources as we can to our clients and investors. But with that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investment or offer any of that structuring advice as well. So if you want to have a consultation, if you're thinking about utilizing your retirement funds for making investments into the alternative asset space, feel free to follow this QR code, take a picture of it, follow the link to set up a consultation with an IRA specialist. Whether you're a client or you're not, doesn't really matter. This is going to be a consultation that's completely free, where you can ask all the questions that have been on your mind when it comes to these alternative asset investments within your retirement vehicles, right? We have a wealth of knowledge with our IRA specialist team here. We have several certified IRA service professionals that'll be able to take that dive with you and get into the nitty gritty of how these investments work within your retirement vehicle. And be sure, if it's something that you're interested in, you want to check out the Quest Expo. Right now, we're offering 50% off all tickets across the board. That is both general admission and VIP tickets. We're going to slash that price right in half to be sure you can have the opportunity to join us for the largest alternative asset expo in the nation, coming up in June 27th through 29th in the Irving Convention Center in Dallas. Like I said, this is not an IRA specific expo, so don't feel that you need to be an IRA investor for this to be relevant to your field. If you're in the alternative asset space as a whole, we will have everything covered here. We're going to talk about crypto. We're going to talk about oil and gas. We're going to talk about what the landscape looks like moving forward in the real estate space and how interest rates, whether they go up or down, could affect those types of investments within these alternative asset space. And so with that, I like to transition to kind of how we're going to talk or how we're going to handle today's presentation. So like I said, Paul is not going to necessarily be talking about the nitty gritty mechanics. He's going to talk about the philosophy, right? The boring investor, how to make sure you are methodically building your wealth to be able to protect the future that you deserve and build the generational wealth that you envision for yourself. So with that philosophy in mind, I'd like to bring out Paul Moore. Paul, are you there?
Zach?
Hey, there we go. All right, we got you. So I'll leave the floor to you and I'll let you take it from here.
Okay, great. Well, thank you. Can you see my slides, Zach?
Yes, we got your slides up now.
Oh, fantastic. Okay, well, I'm Paul Moore. We're going to talk about becoming a boring investor today. There's a little disclaimer. So I'm a 3-time real estate author, fund manager of 6 funds at Wellings Capital, had an engineering degree. That was my first mistake. And I also got an MBA, been married 36 years with 4 kids who love me and still speak to me, even though I was a workaholic and not a boring investor for years. So we're going to talk about that today. My first commercial real estate book is called, humbly titled, The Perfect Investment, about multifamily investing. I love this book until The Perfect Investment multifamily became not the perfect investment. I realized that if you have to overpay, over leverage, use risky floating rate debt, and believe that trees, that is rents, will grow to the sky forever, then you probably don't have the perfect investment. And that's what we found. We'll get back to that a little bit more later. I also wrote a book published by Bigger Pockets called Storing Up Profits, about self-storage. So this is not me, as you can see. In fact, it was never me. I was a type A, very driven entrepreneur. I lacked sleep. I actually did get sleepy at work because I lacked sleep because I worked so many hours. And I made a huge mistake, Zach. I tried to get the same excitement from my investments as I did from being an entrepreneur. In fact, I was an entrepreneurial investor. What happened is I sold my company to a public firm in 1997. I was 33 years old, and I didn't know the difference between investing and speculating. So now I refer back to myself as not a full-time investor, but a full-time speculator. I was an entrepreneurial investor. Entrepreneurial investors love the thrill of the chase. They stay up in startup mode for a long time. They get a rush from the process more than the wealth building. They repeat the learning curve over and over. They get a broad but not a deep knowledge of any given topic. They may hit a grand slam, or they may strike out. They speculate more than investing, and they may live in a mansion at retirement or work at Walmart. And there's nothing wrong with Walmart, but just saying. Okay, so I'm going to talk about the opposite of being an entrepreneurial investor. I'm going to talk about how to become a boring investor. And my copywriting friend said, don't call it that. People don't want to be bored. I submit to you that you should, because boring investors attain true wealth. True wealth is having assets that produce cash flow, predictable cash flow, stable cash flow that's not dependent on the mood on Wall Street or a war in the Middle East or a CEO tweet or scandal. Boring investors attain assets that produce cash flow. And in fact, Paul Samuelson, who was the first U.S. economist to win the Nobel Peace Prize, said investing should be boring. It should be like watching paint dry or watching grass grow. He said, if you want excitement, take $800 and go to Las Vegas. So boring investors attain or can attain true wealth. Boring investors enjoy real freedom. I used to make a joke as an entrepreneur that I had true freedom. I said, I am free to work any 80 hours a week I choose. That's bondage. It's not freedom. Boring investors enjoy real freedom. Boring investors avoid hidden costs. I had a friend named Kevin. Kevin is my friend. In fact, he made a lot of money as a highly paid executive in a tech company in Seattle. And he used to look at his stock options once a day. Then it became once an hour. Then it became once every half hour. And then he became obsessed. He just realized later that he had lost countless productive hours. He lost relationships. He lost health. He got up in the middle of the night to think about it, and he didn't make a dime. In fact, he probably lost money from that. Now, Kevin spends his time on a sailboat in the Puget Sound near Seattle, and he invests passively in ETFs and in passive real estate investments. So boring investors avoid these hidden health, relational, productivity costs that active investors often are dogged by. Boring investors lose money and make a fortune. I had a podcast for years called How to Lose Money. And on that show, we learned from the mistakes of others. We realized it's easier to avoid repeating other people's mistakes than it is to be clever and brilliant. You know, Bill Gates and Warren Buffett said Charlie Munger, God rest his soul, was the most brilliant investor in the world. But Charlie's brilliance, when you asked him about it, it wasn't like creating some amazing formula or brilliant innovation. It was avoiding other people's mistakes. He said that he was the chief mistake avoider. And so by doing that, he said that even though that's a boring tactic for most people, think about how boring that would be to be that brilliant and be basically doing elementary school stuff. That's what Charlie did so well then. Did you know that if you took Berkshire Hathaway's stock price and cut it by 99%, it would still beat the S&P 500 over the last 55 years by 40%. Now think about that. Pretty amazing. That's what boring investors do. Charlie and Warren have perhaps the most boring lives on the history of Wall Street. Study their lives, study their daily routines. Charlie read like 500 books a year. He just sat in a big leather armchair and read all day. And Warren does something similar. So boring investors lose money, but they make a fortune by learning from those lessons, learning from the lessons of others, and not repeating those mistakes. Boring investors realize they might be wrong. You know, our minds are plastic and they should be changed. Chris Davis of Davis Advisors, great investor. He has a wall of shame, not a wall of fame in his office, but a wall of shame where he basically puts up their biggest mistakes, like investing in AIG before 2008. And on their wall, basically, they rub their nose in their own mistakes and they list the bullet points of all the reasoning that went wrong when they bought this stock or that investment. Boring investors realize they might be wrong. They do all kinds of stuff up front to realize, hey, this could go wrong, and how could it? Boring investors invest in boring assets. Yeah, I told you I wrote a book on self-storage. What's more boring than 4 pieces of sheet metal, a floor and a door, and some rivets? What could be more boring might be mobile home parks. Sam Zell started investing in mobile home parks in the 1960s, and he accumulated 158,000 mobile home park pads before he passed away a year or two ago. And, Zell, everybody looked down their nose at him for years for why mobile home parks? And in fact, that's the reaction we got years ago when we started investing in mobile home parks. But of course, they're popular and exciting now. But overall, self-storage, mobile home parks, RV parks, they're boring investments. They're not the latest, Bitcoin trading, currency exchange strategy. You can make money doing those things, but it's really hard to. Warren and Charlie said that they do everything in their power to step, not to jump 7-foot hurdles in the Olympic analogy, but to step over 1-foot hurdles. They invest in boring assets. Boring investors also invest in the gold rush. Well, sort of. The story in 1849 and later in the 1880s, gold miners rushed out west and to Alaska to make a fortune. But, very few people actually even made it to the gold fields in Alaska, the Klondike gold fields, etc. Most of them, I think 60%, either turned back or died along the way. Yet, the people who sold the picks and shovels and hotels and logistics, they actually vacationed on some of the same mountains those people bled and died on. I had this myself. We lost money in an oil and gas deal in North Dakota in 2010, but we realized that there was a huge housing shortage. So we built multifamily housing there in 2011 and again in 2012 and again in 2013. And we basically printed money from those investments. And that's kind of the life of, it's way more boring to invest in housing or picks and shovels, but that's a great way for many people, many times, to get wealthy. Boring investors also diversify. It's way more exciting to invest in one stock that goes up 100x. And that's okay to do that. I mean, some of us have made money doing that, but it's very hard to repeat. Boring investors diversify broadly. Buffett has made fun of people who diversify, but what I realized was he was making fun of individuals who diversified in their operations, like Dairy Queen. Let's say they bought, a dairy farm, to create the milk, and a forest to create the timber, to create the pulp and paper. That would not be a good diversification. But Buffett himself has only 28 staff, yet they have, last I checked, about 109 companies that they either own or invest in. So boring investors diversify. This is a picture of my current fund, Wellings Capital's fund. We're diversified across self-storage, mobile home parks, RV parks, light industrial, debt, multifamily, open-air shopping centers, and even a single family portfolio. We're also diversified within the capital stack as well. And so we recommend that however you find diversification, you do it yourself. Boring investors don't chase shiny objects. I was the chief shiny object chaser. I thought I was a full-time investor, but really I was a full-time speculator. And like I already told you, a serial entrepreneur, which was really a bad plan. Investor extraordinaire. A lot of people don't like this guy, but George Soros said, if investing is entertaining, if you're having fun, you're probably not making any money. Good investing should be boring. And I would add, good investors don't chase shiny objects. Again, it's possible to make money doing that, but it's a lot harder to repeat over and over as a career. Boring investors are simpletons. I already mentioned Charlie Munger. Basically, his investing construct was extremely simple. In fact, Jeff Bezos asked Warren Buffett, hey, he said, I figured out you guys' strategy. It's not that hard. Why doesn't everybody just imitate you? And Buffett said something like this. He said, no, nobody wants to get rich that slowly. So boring investors are simpletons. They're patient, and they traded FOMO for FOMO. We all know FOMO, fear of missing out. That's used to be me in the investing realm. They trade it for FOMO, which is fear of messing up. Warren Buffett said, over the years, a number of very smart people have learned the hard way that a long string of impressive numbers multiplied by a single zero always equals zero. Buffett's number one rule was don't lose money. Rule number two, it. See rule number one. So very important to, if you can just avoid messing up, that I don't know if you've heard this or not, but if you gain 50% on your portfolio, let's say you turn 100,000 into 150,000, that's fantastic. Good job. But if you lose 50%, it puts you in a terrible position, because if you lose 50% and go down to 50,000, now you have to double your money just to get back to square one. That puts pressure on you and makes, maybe not you, but it would make me potentially take higher risks, look for shorter time horizons, and actually could start an investing death spiral. So boring investors trade FOMO for FOMO. This is one of my favorites. Boring investors imitate patterns, not outliers. Jesse Livermore, if you were around 90 years ago, you would know that name, because Jesse Livermore made $4 billion or so in today's money by shorting the stock market right before it crashed in 1929. He became really famous, a huge hero, somebody to replicate, and a lot of people did replicate him. That was the beginning of day trading by many people's estimation. The problem is, even Jesse Livermore couldn't imitate his own success. In fact, Jesse Livermore took his life in 1940. The point is, don't imitate the one-time deal. I mean, how are we going to imitate what Jeff Bezos did? How are we going to imitate, the guy, Zuckerberg, who started Facebook? That would be extremely hard to do and extremely rare. There's so much luck and providence and timing and economic nuance that goes into what, happened to those people at that time. But if you want to imitate Warren Buffett and Charlie Munger, who have done the same boring thing for about the last 60 years, that would be something to imitate. Imitate patterns, not outliers. Boring investors play games they're equipped to win. My friend Bruce actually tried to imitate Babe Ruth. He was in the Boston Red Sox AAA farm team. He was just about ready to go up to the majors along with a lot of other teammates on his team. And one year he decided, I'm going to swing for the fences. He had a fabulous batting average, hitting singles, doubles, occasional triples. He started swinging for the fences, and he hit more home runs than he ever had that year. He also had more strikeouts and the worst batting average ever in his career. And in fact, all the other players, all the other starters on that Boston farm team went to the majors except him. Here he is 26, 27 years later, still making under $100,000 a year. So here's my analogy. Are you really wired to pick individual stocks? Are you really wired to, have a full-time job, a family, hobbies, career, etc., and also invest in real estate on the side? You might be, but it's really, really hard for most professionals to do these type of things, on the side. It's really hard for them to find success in their spare time. And even if it does, if it eats up their spare time, well, your life is you're made of time. So does that really make sense? Boring investors understand what they can control and what they can't control. Who would have guessed the pandemic would happen? Nobody could have guessed that. Many people could have guessed that interest rates will go up, but who would have guessed they'd gone up that fast? Entrepreneurial investors try to bet on things that are completely outside of their control. Boring investors basically say, look, I'm going to invest in stuff that's probably not going to skyrocket overnight, but probably not going to crash if things go bad. Boring investors don't have a crystal ball. Fidelity Magellan's Peter Lynch said, those who live by a crystal ball are destined to eat glass. We don't want to imitate the exceptions. We don't want to try to figure out the future. Howard Marks wrote a fantastic book called Mastering the Market Cycle, Getting the Odds on Your Side. I highly recommend you get that book. Howard Marks said, you can never predict the bottom or the top of any cycle. You can only see that in a rear view mirror. He said, what you need to do is act appropriately for where you are in the cycle right now. Now, this takes a lot of wisdom and character to walk this out, but those who do often become wealthy. Boring investors are really, really patient. Charlie Munger said, the big money is not made in the buying or selling, but in the waiting. That's a pretty good quote. Here's another quote from Buffett. He said, the stock market's a device that transfers money from the impatient to the patient. And again, I love that quote, what he said, what Buffett said to Jeff Bezos. He said, no one wants to get rich slowly. Well, those who do often get there. Boring investors say no a lot. Excuse me. Warren Buffett said that the best investors say no a lot. The very best investors say no almost all the time. This is a look at a 6-month window last year where we said no to 242 out of 247 investment opportunities that we analyzed. Boring investors choose a lane and stay in it. One of our partners at Wellings Capital actually ran for governor of Colorado several years ago. And he said that the really, really successful people he rubbed shoulders with, the billionaires, they had stayed in the same often boring lane for decade after decade, like Buffett, like Munger, like a lot of people who have really become successful. Bill Gates did this. Imagine if Michael Phelps had set out as a kid to win 27 gold medals. Now, he might have said, well, I'm going to learn, the high jump, and I'm going to do hockey, and I'm going to do swimming and diving and 100 other things, hoping to get a medal in all these different things. Well, he didn't. He stayed focused on swimming. And of course, you would have never heard of him if he tried to do 5 or 10 different sports. Boring investors choose a lane and stay in it. Boring investors suffer mockery and misunderstanding. I don't know if you've read the book Snowball about Warren Buffett's life, but it starts with a very dramatic story of what happened to him in 1999. Now, Buffett was a mere youngster of about 69 years old, but his friends said he was over the hill. He was a has-been. In fact, he was at his annual retreat of billionaires in Sun Valley, Idaho, and there were no cameras on, so we don't know everything that happened exactly. But from what I understand, there was a lot of people whispering about how he had lost it. He wasn't investing in tech. He wasn't investing in the internet. In fact, he got up at the end of that conference and he said something like this. He said, I would rather invest in Wrigley's gum than I would the internet. He said, I know how people will be chewing gum in 10 years, but I don't know where the tech bubble will be in 10 years. And of course, he did call it a bubble, and it was, because a year and a half or two later, it completely crashed. And a lot of those people who were mocking him found out that he was right once again. So boring investors often suffer mockery and misunderstanding. They also live next door sometimes. I had a breakfast in Palm Beach, Florida once, and there was a guy, 5 investors were there. I didn't know any of them well. And one of the guys who were there, he just didn't want to talk about what he did. I said, what do you do? He said, just flip a few houses. I suspected something was up with this guy. So I kept quizzing him, found out that he was the retired CEO of Office Depot, the retired president of Ulta, and Michael's CEO. He had done all 3 of those things, but he said he was tired of missing his kids' PTA meetings and ballet recitals. In fact, that day he drove off in a Ford Explorer after our meeting when another 20-something guy there drove off in a Tesla. Nothing wrong with Tesla. I'd love to have a Tesla, but I thought it was interesting that, he was just like an everyday average guy. And I thought that was pretty cool. Boring investors often live next door, and they always invest in relationships. Now, Elon Musk is one of my heroes in many ways. He's perhaps the second or third wealthiest guy in the world, depending on what day it is. But, Elon's got 11 different kids by 3 different women, and some of them don't even talk to him. He hasn't invested in relationships real well. I can't judge him. I knew better, and I did the same thing myself for years. I barely connected with my wife and kids some months when I was working on big projects. And honestly, I regret that. And that's what I mentioned at the beginning of the show, that, 4 kids all still love me. It's amazing to me sometimes. I wish I would have invested more in relationships while those kids were growing up. And I highly recommend that you take a look at that as well. Boring investors often invest in silence, solitude, and Sabbath. Now, I used to love weekends. because the emails slowed down, phone calls slowed down, and I thought I can get more done on Saturday and Sunday than the rest of the week. Well, I realized that I was running too hard for too many decades, and now I've slowed down. I'm investing more in silence every day. I spend time meditating and journaling in the morning, spend time in solitude, and spend time in Sabbath, meaning taking days and evenings off, either alone or with my family. Boring investors invest in happiness. This is crazy. If you haven't heard of this, there are Harvard studies and other studies that prove that once you get up above a certain income level, you hit happiness satiation level. Hope I said that right. Which basically means that once you hit, let's call it $100,000. There's different studies that have different numbers. So, but let's call it $100,000. After that, you don't get any happier. If you make 200, 300, 2 million, 300 million, whatever, you don't get any more happiness out of it. So think about that. If you're already at that happiness satiation level, which lots of studies have said are between like 90 and 100,000, let's say it's even 150,000 with inflation, you're probably not going to get any happier. So is it really worth it to grind any harder? That's just my question for you today. Boring investors invest in happiness. They also invest in the unseen realm where there's apparently no return on investment. I don't know how many of you have heard of William Wilberforce, and I wish we were in a live crowd so I could, ask you to raise your hands. But William Wilberforce lived the same time as Napoleon and George Washington, yet you probably never heard of him. I would submit to you that he should be one of the most famous people, if not the most celebrated person in the last 1,000 years of world history. William Wilberforce was very wealthy, very privileged, the youngest guy ever, at least at the time, to be elected to Parliament at 21 years and 2 weeks, which is the youngest you could get elected to Parliament. He had basically a castle right outside of London. And he found out about the horrors of the slave trade. And he basically went on a quest the rest of his life. He sacrificed his reputation, his friendships, his wealth, his health, everything he could. And he basically, halfway through this, like 37-year struggle, he saw the slave trade outlawed. And then 3 days before he died in, I believe, 1833, he saw all slavery outlawed in the United Kingdom. And of course, that spilled over to the United States. And now there are tens of millions, hundreds of millions, maybe billions of people who can thank him for that. There's actually a follow-up to that I'm going to hit in a minute, an unfortunate follow-up. But boring investors, they invest for a testimony, not a title. King George had the title. George Washington had the title. Napoleon had a title, but William Wilberforce has a testimony, and he's also left a legacy. My advice to you guys would be, don't wait till you retire. Don't wait till you've made, that you've accumulated tens of millions of dollars to start leaving a legacy. You can do that today. And one way is to do that is to find something you're passionate about and get behind it now. Now, I told you about William Wilberforce. Wellings Capital is very passionate about this. We were horrified to find out that if you took the record profits, not the average, the record profits of ExxonMobil, Nike, Starbucks, and General Motors, added those record profits together and added about 20% more, you'd come up with the approximate profits of human trafficking every year, at least last time we checked the numbers in 2023. So it's very horrifying. We didn't know what to do at first, and you might not know what to do. The size of the issue is horrifying. And there's a problem for us who want to get involved. The problem is, what do we do? Do we send money off to somebody we don't know where it's going? Do we go on a commando raid like that cool guy in Sound of Freedom movie? Well, we came up with a solution which is similar to how we vet commercial real estate deals. We vetted the best operators we could come up with, and we donated 5% of our 2022 profits to an organization called AIM. You got about them on aimfree.org. The slide has not been updated. I just realized this. But we have donated, influenced, and raised over $600,000 since 2021 to aimfree.org. If you want to get involved, you can reach out to us. I'll give you that slide in a minute. Or you can just go, better yet, just to aimfree.org. And you can donate. You can learn more about their mission, what they're doing in Cambodia and Belize, and you can donate to them. If you want to get hold of me, you can do that at wellingscapital.com. If you want to email me or text or call me, you can do me at that bottom. You can use that bottom number. I'm super honored that you were here today and that I got to join you. And I want to thank our host, Quest IRA. I want to thank Zach and Mackenzie for putting this on. Thank you for being here, and want to recommend that you build wealth and that you build a future by becoming a boring investor.
Awesome. Thank you so much for that, Paul. I really, really do appreciate it. This is something that, as I've gotten to spend more time in this space, and gotten to, have conversations with different groups of investors, kind of the one thing that shines through that was surprising, to be honest, when I first heard it, was that the mistake a lot of investors will make will be that they will chase yield, right? Yield chasing, and they're just going to go for the highest return, the quickest, and they just want to feel like they can hit these home runs back to back. And it's just from the people who are established here, the people who have been in this industry for a while. It seems like across the board, that's just, they echo that kind of sentiment, that it's a huge mistake just to simply chase the highest returns at all times, rather than setting a consistent, repeatable method for getting your returns on investments.
Yeah, it's so true. It's I have so many stories about this. I mean, my own stories. Like I said, I had a podcast called How to Lose Money, and Zach, on there, we told our own stories, and we interviewed 238 successful entrepreneurs and business owners and investors who lost a lot of money, especially in the great financial crisis. And you know what the crazy thing is, Zach? A lot of them, in fact, almost everyone I asked said they're glad it happened, even though there was only like sometimes 5 to 10 years between the time it happened and the time of the interview. And they said they're glad it happened because now they're a better investor, a better friend, better husband, wife, better business owner. And that should remind all of us, if you face a dark day, if you face something where you think, man, I should just end it all now, don't end it. Don't just realize that just 5 years from now, you might be glad it happened. It may seem impossible right now to believe that, but Zach, I know we're old enough to realize that those painful moments sometimes can be the springboard to the next level.
Absolutely. Absolutely. As a matter of fact, that's something that, as I got older that happened while actually I was here at Quest. Where I'm at now compared to when I first started at Quest, I just moved to Houston before starting at Quest. I had to sell most of the things I had just to kind of cover the rent until I was able to find a job. And it was bleak. It was something I didn't really know how I was going to be able to navigate it. And then now, now I'm able to have conversations like this, be able to participate, in investments like this. It's just, it is astonishing what 5 years can do. And there's a question in the chat here. So I want to bring that up. So obviously, you can't get too specific, but someone who's, that looks like they said they're 56, W-2 employee, got $100,000, what would you consider a boring investment strategy? And not, like I said, everyone's financial situation is going to be dependent. But you give any insight?
Yeah. So, D, if you are an accredited investor, opportunities, especially through a self-directed IRA like Quest offers, to invest in all types of real estate things. If you do real estate, I'd recommend you consider passive investing in a diversified portfolio. And there's a lot of great ones out there, or a fund. And if you are not an accredited investor, and you can look up, how to define that, I'd highly recommend you consider just investing in ETFs. Charlie Munger, in one of his last interviews before he passed away last November, told, I think it was Wall Street Journal, he said most investors should just invest in ETFs unless you think you have a very special gift and the time and the ability to pick stocks, which hardly anybody has. You should just go and, invest in the entire market, if you will. So does that make sense to you, Zach?
Yeah, absolutely. And rather than kind of having to go through and pick, and I've had these conversations with clients as well, especially when they don't know really how to navigate the public market. I tell them, look at things, like you said, like ETFs, things like index funds, where it's just following the trends of the market, where you're not having to pick individual stocks, get in and get out at the right times, because most people, even if you have the time, that is such a niche skill set that is just incredibly difficult to really master. It's one of those things that I feel like people will see day traders, right? And they'll see the people online on social media talking about day trading, and they make it look very flashy, but no one talks about how many day traders are, have struggled, or simply have had to stop because they've completely failed at it. It's easy to make it look flashy, very hard to execute.
I've known 5, Zach, and all five out of 5 lost all the money they invested.
Exactly. It's one of those things that I feel like people use. I always try to tell people when they see someone on there talking about, oh, hey, I'm a successful day trader, and they're making all these videos. 9 times out of 10, that video is going to end in trying to sell you a course. That's how they're really making their money, right? So
that's right.
It's very, very hard. So I completely agree with that. Invest in general, and then obviously if you see an opportunity for a specific scenario, like for example, for me, there was one time where I had just I had heard news that a company called DraftKings had just been acquired by a SPAC, and they'd taken them public, and it was right at the time where online gambling was becoming more and more popular in different states. And I thought, okay, well, this seems like a good opportunity. And at that time, I pulled the trigger, and it just happened to work out. Since then, haven't repeated it. I haven't tried. It was something I stumbled upon, and it came to me. By no means am I looking for it. So looks like there's another question in the chat showing what is the most boring investment for investors? Let's say 250,000 looking for alternative investments, which I think kind of goes towards the last answer you had. So if you want to expand on that a little bit more.
Yeah. So our fund invests in RV parks, and they're really kind of like the hot thing right now. People are so excited. And, the RV park projections, some of them are projecting 20 to 25% cash flow net to investors right now. So you might think, well, maybe I should invest in an RV park. But you know what? There's also other asset types that aren't as exciting that are throwing off great returns in some cases right now. And if I had a lot more time, I could tell you more about self-storage, mobile home parks, and tax-abated multifamily, things like that. I would recommend that you try to get, maybe 5 investments, Dolores, with 50,000 in each, if you could. Rather than trying to hit it out of the park by putting it all into one. I've made that mistake too many times. I mentioned the oil and gas deal. I put all the IRA money I had liquid into that oil and gas deal in North Dakota, and I lost all of it. I did make a lot of money later, like I said, building housing for those oil workers, but that doesn't negate the fact that I lost all my liquid capital that I had right at that moment. But because I was absolutely convinced, after all, I had a petroleum engineering degree. And so I thought, how can this go wrong? I really thought that. And it turns out that they hit oil 6 out of 6 times with these initial wildcat wells, and they never produced a single drop of it because it turned to tar in the drill stem, and they don't know why. So even the best thing can go wrong.
Yeah. Another investment class that I've seen, it seemed like it's gaining more and more popularity, was build to rent communities.
Oh yeah.
It seems like, and it makes sense, right? That as we go along, interest rates are high. Banks are it's not only is it more expensive to borrow money, it's also, banks are becoming more restrictive on who they're willing to lend to. Housing prices are going up, and it's taking people longer to save up for the house that they want, and that's even if they want to, right? A lot of times is, especially with the younger generations, is that they're putting more of their capital towards either investing on their own or going towards life experiences, and then they're okay with renting for longer and later on into their life. So it seems like that's going to be something that becomes more and more popular.
Yeah, I would put some of that money into build to rent. Now, would I manage it actively? Not unless I had 40 hours a week and a team of people to do it. But I would consider putting some in that for sure.
Absolutely. So, well, it looks like that's it, Paul. I appreciate it so much. Thank you for coming out. It's not too often that we get these types of presentations. Like I said, a lot of times we spend our time, either talking about specific investment class, specific investment strategies, or really the mechanics of how these investments work. It's not too often we can really take a step back and talk about the mindset of investing and how to approach it. So I really do appreciate that. If you want to go back a slide and let people know how to reach out to you again, just so they can reach out if they have any questions.
All right, there you go.
Awesome.
Well, Zach, it's been great. And I would love to come back on and talk about any of these asset types that we've invested in, and even the ones I've failed in the past, if you'd like to do that again. But today was really enjoyable. I just get a charge every time I think about, this idea of being boring and building wealth through being boring. And it gives me more energy to focus on my family, my hobbies. I play pickleball now. I'd rather have excitement playing pickleball and be bored in my investing,
That's exactly right. That sounds like the kind of life I'd be looking forward to. Thank you again, Paul. And thank you everyone for joining us. If you have any questions over your IRA, feel free to reach out to Quest. We're always happy to help. And until then, we'll see you guys next time for our self-directed IRA Saturday coming up this Saturday. Thank you guys.